We are strapping in for a pretty high voltage analysis, you could say. We're looking at a company that's really central to Turkey's renewable energy goals and, interestingly, also expanding quite rapidly into Europe. That's Smart Güneş Teknolojileri A, or SMRTG for short.
That's right. And for you, the individual investor listening, this is a really important one to get your head around. Why? Because SMRTG's latest results, the first 9 months of 2025, they show this perfect storm.
A storm? How so?
Well, it's aggressive expansion meeting massive investment, all happening under specific regulatory conditions, but also leading to some serious short-term financial pain.
Okay.
So our mission today is to take their activity report, their financial statements, all the official stuff up to September 30th, 2025, and really break it down, make it digestible. What's the strategy behind these numbers?
Right. We're not just going to read off a spreadsheet. We want to understand the why. Why these huge investments? Why now? What's the long-term value proposition when the short-term profit looks, frankly, pretty bad?
Exactly. It's about connecting the dots between the CapEx and the strategy.
So let's start at the beginning. We need to ground ourselves. Who is SMRTG? How did they get to where they are in this solar market?
Okay, so SMRTG, founded back in 2014, got its current name in 2016. They're based in Istanbul, that's the HQ.
But the real action, the production, that's elsewhere.
Precisely. They have two major production sites. There's the established one in Gebze, and then the really big, newer facility in Alyasa.
Let's talk scale. Gebze sounds pretty significant on its own.
It is. Gebze covers about 23,500 square meters, and it churns out about 1,200 megawatts of panel capacity. So, yeah, significant.
But Alyasa, you called it a monster facility.
Well, it kind of is in terms of scale and what it represents strategically. We're talking over 58,000 square meters.
That's huge, like 8 football fields or something.
Yeah, something like that, yeah. And it essentially doubled their total panel capacity, bringing it up to 2,400 megawatts. But honestly, the square footage isn't the main story.
It's the integration you mentioned earlier.
Exactly. Elias represents a massive shift towards vertical integration. They're not just assembling panels anymore.
Okay, so break down their business model for us. What are the core pillars?
Two main things. First, they manufacture high-spec PV modules and, crucially now, cells. They're using really advanced tech here, multi-bus bar, top econ, PRC, bifacial panels.
These aren't just run-of-the-mill panels, then?
No. These are designed for high efficiency, maximizing energy output, especially for large solar farm projects. Think cutting-edge manufacturing.
Okay, high-tech manufacturing is pillar 1. What's pillar 2?
Pillar 2 is their EPC division, engineering, procurement, construction.
So they build the solar farms, too?
Exactly. They offer turnkey services, start to finish. They can design it, source everything, build it, connect it to the grid. This lets them capture value all the way through the project lifecycle.
Makes sense. From making the core component to installing the whole power plant, that must require quite a footprint, internationally as well.
It does, and they've built one. They're positioning themselves as a multinational player. As of Q3 2025, they've got offices, subsidiaries, Netherlands, Spain, Germany, Bulgaria, Ukraine, though that's obviously inactive for now.
And the U.S. too, I saw.
Yes, Smart Green Energy Technologies, Inc.,
Yeah.
and a trading LLC over there. And back home in Turkey, they've got this huge network, over 100 dealers covering the country. So the reach is substantial.
Okay, let's circle back to Alia and this vertical integration. You said it was expensive, but strategically brilliant. They didn't just add more panel lines. They moved upstream, right, to cells and even wafers.
That's the game changer. It was a phased but very rapid investment. Cell production, about 800 milliW capacity, kicked off late 2024.
And then wafers. That sounds like a huge leap.
It was. July 2025, they started producing wafers domestically. 1,500 milliW capacity. That's a massive undertaking.
Because wafer production, that's incredibly capital intensive, right? And usually dominated by Asian manufacturers. Why would SMRTG pour billions into making something they could just import, seemingly cheaper?
But is it cheaper anymore? That's the crux of it. The why is all about reading the regulatory tea leaves and building resilience. It wasn't just an investment in factories. It was an investment in a competitive moat, almost underwritten by government policy.
A moat? How? How does making their own wafers protect them?
It shields them directly, dramatically, from huge cost hikes hitting their competitors.
Okay, explain that shield mechanism.
Two parts, tariffs and incentives. First, the tariffs. July 2025, the government doubled the surveillance tax on imported wafers and cells.
Doubled. From what to what?
From $85 per kilogram to $170 per kilogram overnight.
Wow. So any competitor importing those key components suddenly saw their costs explode?
Precisely. But SMRTG, now making them domestically in Aliaza, they just don't pay that tax increase on their own production.
So their input costs are structurally lower now?
Instantly. It gives them massive flexibility. They can either pocket higher margins or compete more aggressively on price, while import-reliant rivals are squeezed. It's a huge competitive advantage baked in by regulation.
Okay, that's the shield. What about the incentives you mentioned? How does the CapEx get rewarded?
Well, the government is actively pushing for made-in-Turkey solar components. An August 2024 rule limited incentives for panels using imported cells. Then, a September 2024 rule specifically boosted incentives for wafer-integrated production.
So by going all the way upstream to wafers, SMRTG perfectly aligned itself.
Exactly. They've basically guaranteed themselves access to future big government projects like the week A auctions, which often mandate high levels of domestic content. They become a strategic national supplier, playing into Turkey's energy self-sufficiency goals. It's smart. Very smart. Hashtag tag 1.3 sector dynamics and market position.
Okay, let's zoom out a bit. The global picture for solar. The IEA numbers are just staggering. More power than the entire U.S. grid by 2030.
It's almost hard to grasp the scale, isn't it?
Yeah.
But yeah, that's the projection. Renewables set to be 80% of all new capacity globally by 2030. Global solar capacity heading towards, 7,600 gigawatts?
So SMRTG is tapping into this massive global tailwind.
Absolutely. Their expanded capacity is aimed right at this curve. And they're trying to play the international regulatory game, too.
You mean in the U.S. and Europe?
Yeah, there's a dual opportunity. The U.S. Inflation Reduction Act, the IRA, has created huge demand for panels. Turkey is well-positioned as an exporter, especially with some restrictions on Asian competitors.
And Europe. There's the Carbon Border Adjustment Mechanism, CBAM.
Right, the SKDM, as it's known in Turkey. That puts pressure on importers to account for the carbon footprint of goods. SMRTG's focus on local integrated production could give them an edge there, potentially demonstrating a lower carbon footprint than components shipped halfway across the world, better control over their supply chain.
Makes sense. Now, back home in Turkey, the growth isn't just hoped for, it's practically mandated, right?
Pretty much. Electricity demand is climbing steadily, forecast at 3.5% annually till 2035, and solar's share of the pie is exploding. It went from about 14% of installed capacity at the end of 2023 to 20% by September 2025.
And the national plan?
The Turkey Ulusal Energy Plan aims for nearly 53 gigawatts of solar by 2035. That's a massive target. It basically guarantees a strong domestic market for companies like SMRTG for over a decade.
Okay, one more thing on the operational side, related to their EPC business. The report mentions this super permit law change. Sounds a bit dry, but you suggested it's a big deal.
Well, it's huge for EPC. It cuts the permitting time for large solar projects from a potential 48 months, 4 years, down to under 2 years.
4 years down to under 2. How does that impact SMRTG directly?
It's a massive cash flow accelerator. Think about it. Before, you might win a contract, invest some capital, but then wait years for the final permits before you can actually build and crucially start getting paid properly, recognizing revenue.
Ties up capital, increases risk.
Exactly. Slashing that timeline means they can execute projects much faster, get revenue coming in sooner, free up capital quicker, and basically turn over their entire EPC order book much more rapidly. It's a gift for efficient operators.
Right. Let's shift gears a bit. Who's actually running the show here? The ownership structure seems pretty concentrated.
It is. The main player is Smart Holding A. They hold about 73% of the actual capital.
Okay, but I saw their voting power is much higher, nearly 86%.
That's right. And that difference is key for you as an investor to understand. It comes down to share classes.
Ah, different types of shares with different voting rights.
Exactly. SMRTG has Group A shares and Group B shares. Group A shares get 5 votes each, and critically, they have the sole right to nominate board members.
And those are held by Smart Holding, presumably?
Yes. The Group B shares are the ones mostly traded publicly. That's the 27% public float. They're bearer shares, standard, 1 vote each.
So public investors have shares, but very little say in the strategic direction or who sits on the board.
Essentially, yes. Control rests firmly with Smart Holding. They dictate the long-term strategy, insulated from the day-to-day pressures of the public market.
We did see they've done some capital increases funded internally and also a share buyback earlier this year.
Yeah, several capital hikes using internal resources. The last one took them to about 606 million TL in capital back in July 2023. And the share buyback program ran until February 2025.
How much did they buy back? Did it make a difference?
They bought back 520,000 shares, average price around 45.74 TL. But honestly, it was tiny, less than 0.1% of the total capital.
So more of a signal than a major support mechanism.
I'd say so. A signal that management was willing to step in a little, maybe try to ease selling pressure, but not a huge intervention. Hashtag 2.2 management and governance.
Okay, let's look at the board itself. 11 members, elected last May for 3 years. And something stood out in the report regarding gender diversity.
Yes, and they highlight this quite deliberately. There are 5 female members on the board. That's a 45% ratio.
Which is unusual for this sector.
Very unusual, especially for a heavy industry, manufacturing company. It's significantly higher than average. They explicitly link it to their commitment to UN Global Compact goals on gender equality and leadership. It suggests a modern approach to governance.
And what about independence? How is oversight structured? Risk management?
The structure looks pretty robust on paper. They have the standard committees you'd expect: audit, corporate governance, early risk detection, and importantly, a sustainability steering committee.
Right.
But the crucial point is who chairs them. All 4 committees are chaired by independent board members. There are 4 independent members in total.
Why is that so important?
It means the oversight functions, checking the financials, monitoring risks, ensuring good governance, are led by people without direct executive ties to the company. It provides a layer of objective scrutiny, which is vital.
Good governance practice. Now let's touch on the workforce briefly. You mentioned a risk factor later.
Right. So the workforce is relatively young, average age around 35. Total employees just over 1,100, slightly down from the end of 2024.
And the company states wages are high.
They emphasize that average wages are more than double the minimum wage. They clearly want to project an image of being a good employer.
Where's the catch?
There's a significant catch disclosed right in the report. Despite the high wages, there was a strike decision made by the Birleşik Metal İş Union for the Gebze plant, scheduled for late October 2025, so after the period covered by these financials.
A strike? That sounds serious for a key production facility.
It is. We need to keep that in mind when we talk about outlook. It's a major short-term operational risk looming just beyond the balance sheet date. Hashtag 2.3 SMRTG's commitment to sustainability, ESG.
Okay, before we dive into the financials, let's quickly cover their ESG, environmental social governance positioning. It seems like more than just box ticking for them.
I think so. They seem to view it as a competitive factor. Getting included in the Bias Sustainability Index from the start of 2025 was a big domestic validation.
And internationally?
They get a B management level score from the CDP, the Carbon Disclosure Project, for their climate change reporting. That was February 2025. B management means they're not just reporting emissions, they're actively managing them, setting targets, implementing strategies. It's a good score.
And they're backing this up with how they raise money, green finance.
Yes, definitely. They secured a specific green loan from ING Bank, about 20.6 million euros, tied directly to building that big New Day solar project we'll talk about later. Repayment stretched out to 2030.
And something about sukuk.
Right. They also applied to issue green or sustainable sukuk. Those are Islamic financial certificates, basically asset-backed securities, up to 250 million TL.
Why sukuk? Does that open different doors?
It can, yes. It taps into specific pools of global capital looking for Sharia-compliant investments and increasingly sustainable ones, too. It diversifies their funding options beyond traditional loans and bonds.
Okay, now we get to the really juicy part, the numbers. This is where that tension we talked about, strong operations versus that big loss, really comes into focus. Let's dissect the 9-month results for 2025 compared to 2024.
Right. And we have to start at the top line, revenue or hasılat.
And it's down quite sharply.
Yes, down 26.35%. From over 10 billion Turkish lira in the first 9 months of 2024 to 7.4 billion in the same period of 2025.
Ouch! $1 billion lira drop. What does that signal?
It suggests a slowdown compared to the previous year, either in the volume of panels and projects sold or maybe pressure on pricing. 2024 might have been an exceptionally high demand period, but context is everything here.
Because despite that big drop in sales, the profitability metrics tell a different story.
A very different story. Look at gross profit. Yes, the absolute number is down about 16% following the revenue drop, but the gross profit margin,
it went up
significantly, from 18.01% in 9M 2024 to 20.45% in 9M 2025.
Okay, hold on. Sales are down by a quarter, but they're making more profit on each lira of sales.
That's the payoff from Alias starting to kick in. It points directly to better cost management. either tighter controls on their EPC projects, or, much more likely, the impact of using those domestically produced, tariff-shielded cells and wafers.
So their cost of goods sold dropped relative to their selling prices.
That's the strong implication. Even with lower overall sales, the profitability of each sale improved. That's a sign of operational strength.
Okay, what about EBITDA? FA in Turkish reporting, that's a key measure of core operational health.
Right. And here the story gets even stronger. The absolute EBITDA figure was basically flat, up just 1.3% to 1.26 billion TL.
Flat doesn't sound amazing.
But again, look at the margin. The EBITDA margin expanded massively, from 12.37% in 9M 2024 up to 17.02% in 9M 2025.
Wow, okay. That's a big jump, nearly 5 percentage points.
It's huge. It confirms unequivocally that the core business-making panels installing projects became substantially more profitable and efficient during this period, despite the top-line contraction.
So operationally, things are looking pretty good. Healthy margins, better efficiency. But then we get to the operating profit, İsas Faaliyet Karya, and it's down over 60%. And the bottom line, net income, it's a massive loss.
Yes, and this is the absolute core of the story for investors. Operating profit plummeted, and the net result swung from a 439 million TL profit in 9M 2024 to a 729 million TL loss in 9M 2025.
A swing of over 1.1 billion lira. What on earth happened? If operations are healthier, where did the profit go?
2 words. Financing burden. Finansman giroleri.
The cost of debt.
Primarily, yes. Total financial expenses hit 2.69 billion TL in the period. Remember all that massive investment in Aliasa, the new production lines, the big Yika project? They funded a huge chunk of that with debt.
And the interest payments are now hitting the income statement hard.
Crushing the bottom line.
Yeah.
The management themselves say these investment financing costs are Baskalasa suppressing profitability right now.
But hang on, in Turkish accounting, especially with high inflation, isn't there another big factor that can create huge reported losses? TFRS 29, inflation accounting.
Yes. You absolutely have to factor that in. TFRS 29 mandates adjustments for inflation, and for companies with lots of assets and significant debt, this often results in very large non-cash monetary losses, or net parasol kayıp.
Non-cash. Meaning it looks bad on paper but doesn't actually affect their cash balance in the same way.
Correct. While the report doesn't break down the 2.69 billion financial expense figure in this summary, it's almost certain that a significant portion of that, and thus this overall net loss, is driven by these TFRS 29 inflation accounting adjustments on top of the real cash interest payments.
So the 729 million TL loss, it's a mix of real debt costs and these potentially very large non-cash accounting charges.
Precisely. The debt cost is real and significant, don't get me wrong, but the final net loss figure is heavily influenced, likely inflated, by inflation accounting rules. It's an investment loss and an accounting loss, not necessarily a sign the core business is failing. Hashtag 3.2 balance sheet snapshot, 30.09.2025 versus 31.1.2024.
Okay, let's look at the balance sheet then. Where did all the money go? Total assets seem stable around 21.9 billion TL.
Stable overall, yes, but the composition changed dramatically. Look at non-current assets, duran varlıklar. They jumped over 21%, up to 10.35 billion TL.
And that's the physical stuff, the factories, the projects.
Primarily, tangible assets, meri duran varlıklar, rose from 6.7 billion to 8.6 billion TL. That's Aliasa coming online, that's the NİDE project being built. It shows the CapEx strategy physically materializing on the balance sheet.
But that investment had to be paid for. What happened on the current asset side?
That's where you see the cost. Current assets actually decreased by almost 14%. Cash and equivalents halved, down from nearly 600 million TL to under 300 million.
In inventory. Stocks.
Stocks also dropped significantly from 2.8 billion down to 1.8 billion TL. They were clearly burning through cash and potentially selling down inventory to fund the massive build-out. Liquidity was sacrificed for asset growth.
Aggressive. Now the other side of the coin, liabilities. How did they fund it?
Well, short-term liabilities increased, up about 6.6%. And the driver, short-term borrowings, they shot up from 3.2 billion TL to nearly 5 billion TL.
Okay, there's the source of that financing pain on the income statement. A huge pile of short-term debt.
Exactly. That's risky. Short-term debt usually carries higher interest rates and needs refinancing constantly. It explains the pressure. Their plan to convert this to long-term debt is absolutely critical.
But amidst the debt, there was a surprisingly positive sign in liabilities. Deferred revenue.
Yes. Artlan Mishka Lirler. This is a fantastic indicator. It nearly doubled, soaring from 2.76 billion TL to 4.90 billion TL.
Remind us what deferred revenue is again and why a big jump is good news.
Deferred revenue is basically cash received from customers for goods or services. SMRTG hasn't delivered yet. Think large down payments on big panel orders or EPC contracts.
So it's future revenue that's already been secured, cash in the bank.
Pretty much. It's like an interest-free loan from customers. This massive increase strongly suggests they've been very successful in winning large new contracts with advance payments. It guarantees billions in revenue that will be recognized in future quarters as they deliver. It significantly de-risks the forward sales pipeline.
A very important counterpoint to the current loss. Finally, equity as kaynaklar. It decreased.
Yes, down about 14.7%. That's the direct mathematical consequence of the 729 million TL net loss reported for the period. Accounting losses reduce the equity base. Hashtag 3.3 cash flow analysis.
Okay, the moment of truth. Given the net loss and the noise from inflation accounting, what does the cash flow statement tell us? Is the actual business generating cash?
This is where the operational health story really shines through. Despite that big accounting loss, cash flow from operations was strongly positive.
Positive? How much?
A positive 1.3 billion TL. And importantly, that's up substantially from 834 million TL in the same period last year.
Wait, how can they report a 729 million TL loss but generate 1.3 billion in cash from operations? That seems like a massive contradiction.
Because the operating cash flow statement strips out all the non-cash items that drag down the net income figure. Things like depreciation, amortization, and crucially, those big TFRS 29 inflation accounting adjustments we talked about.
So the underlying business, when you look at actual cash generated, is healthy and improving.
Fundamentally, yes. Generating 1.3 billion in cash confirms the story those improving margins were telling us. The core business model works. It's cash positive. The reported loss is overwhelmingly driven by the financing costs of the growth strategy and by accounting rules, not by operational failure.
Okay, so if operations generated 1.3 billion in cash, where did it go?
It went straight back out the door into investments. Investing cash flow is deeply negative, minus 2.32 billion TL.
And that's the CapEx.
Almost entirely. Minus 2.32 billion TL, specifically for Madidran Varlık Alımları purchases of tangible assets. Every bit of cash generated, plus everything they borrowed, was immediately plowed back into building those factories and solar parks.
Confirms the strategy in action. And the financing cash flow. Shows the borrowing.
Yes. Positive 840 million TL net inflow from financing activities. But the underlying numbers show huge activity. They borrowed 5.36 billion TL and repaid 3.92 billion TL during the period. It highlights just how actively they were managing debt to fuel that investment pace.
Right, let's look forward then. All this spending, these new assets, they need to start generating returns soon. What's the status of their key projects?
The big one domestically is the Nizdebor Yika GES project. That's their 130 milliwatt peak flagship solar park.
And critically, it uses their own integrated production.
Yes, that's the key. It was built using cells and panels made in their own Alyasa facility. It's the proof of concept for the whole vertical integration strategy.
And the good news is it's starting to come online.
Very good news and very timely. The report notes a crucial event after the balance sheet date. On October 14th, 2025, just weeks later, 93 megawatts, that's 93% of the total capacity, received final acceptance from the ministry, meaning it officially switched from being a construction cost center to a commercial power plant, generating electricity and, crucially, revenue. That's the first major wave of cash generation starting to flow from these big investments.
A very positive development. And they're not just building standard solar farms, they're looking at storage too.
Definitely planning for the future grid. They've secured pre-licenses for 7 of their own projects, combining solar with battery storage, 240 milliwatt of solar, 184 milliwatt of storage. Plus, they're developing over 50 similar projects for clients. Storage is key for grid stability with high renewables.
And venturing into even newer areas, green hydrogen, e-mobility.
Yes, setting up dedicated subsidiaries. Smart Yesel Hydrogen for green hydrogen technologies, they own 70%, and Smart Solargize Yesel Mobilite Energy, 100% owned, which actually started operating EV charging stations back in 2023. They're diversifying across the energy transition landscape.
Yeah.
Hashtag 4.2 international expansion successes.
Their strategy isn't just domestic, though. Big wins reported internationally, particularly in Bulgaria.
Yes, the Bulgarian development is potentially huge. Their subsidiary there was officially designated a priority investor by the Bulgarian government.
what does priority investor actually mean in practical terms?
It means serious government backing for their planned €122 million investment. This includes building a panel and cell factory in Bulgaria, plus more solar projects.
So preferential treatment access.
More than that, it comes with concrete benefits. They've been allocated 160,000 square meters of land. And crucially, they're set to receive a non-refundable cash grant from the Bulgarian state.
A grant, how much?
Approximately €34 million, paid out between 2026 and 2029. That's essentially free money from the government to help build their European production hub. It massively improves the economics of that expansion.
Wow, that's significant support. And there was also a win in Albania, securing long-term prices.
Right. A consortium where SMRTG has a 31% share won 2 projects in an auction, totaling about 60.5 milliW capacity.
And the key there was the CFD, contract for difference.
Exactly. Winning a CFD means they've locked in a fixed price for the electricity sold from those plants for 15 years.
So no worries about fluctuating market prices for that output.
Precisely. It removes price volatility risk and guarantees a stable, predictable revenue stream for a decade and a half. Great for financial planning and securing project finance.
Yeah.
Hashtag tag 4.3, critical disclosures and future expectations.
Okay, given the big net loss on the books, how are external credit rating agencies viewing SMRTG right now? Are they worried?
Apparently not overly worried about the long term. JCR of Rossir Rating reviewed them in July 2025 and maintained their long-term national rating at A with a stable outlook.
A stable, despite the loss.
Yes. It suggests the rating agency sees the current situation, the loss driven by strategic capex, as temporary and part of a credible growth plan, not a sign of fundamental weakness. They likely expect the new assets to improve the financial profile soon.
And management clearly shares that optimism. What are they telling investors to expect?
They're explicitly saying they expect the financial burden to ease in late 2025 and through 2026.
Based on what?
2 main things. First, the improving operational performance, those strong EBITDA margins we saw. Second, the sheer volume of new business they've signed. They mentioned over $500 million worth of contracts signed just in 2025. As they execute those, and as NIDI ramps up revenue, the cash flows should start to offset the financing costs more effectively.
Okay, but we need to come back to that risk factor. The potential strike at GiantThe scheduled for just after the reporting period. How serious is that?
It's a significant short-term risk that investors absolutely need to watch. While the company highlights its high wages, the fact that the Birleşik Metal İş Union still voted for a strike suggests there might be other issues at play, maybe working conditions, benefits, union recognition. We don't know from this report.
And the company mentioned a lockout.
Yes, they noted their right to implement a lockout. Either a strike or a lockout at a key facility like GiantThe could halt production, delay deliveries, mess up those new contracts, and hit the improving margins hard. It's a major uncertainty hanging over the very near term.
Definitely something to monitor. Finally, their plan to deal with that big pile of short-term debt. They know it's an issue.
Yes, they have a stated strategy. The goal is to convert the risky short-term borrowings into more stable, long-term financing, ideally denominated in foreign currency.
Like that green loan for NIDE.
Exactly like that. Spreading the repayments over a much longer period, potentially locking in rates, maybe matching currency exposure if they have euro revenues from exports or foreign projects. It's essential to reduce that immediate pressure from the 5 billion TL in short-term debt. The success of this debt restructuring is key to achieving sustainable profitability. Hashtag outro.
So let's try and synthesize all of this. What does this deep dive really mean for you, the individual investor looking at SMRTG? It seems like a classic story of growth pains.
I think that's a fair summary. It's aggressive, strategic growth. The core tension isn't about operational failure. The business itself seems to be getting healthier, more efficient.
Right, the margins are improving.
The tension is this massive self-inflicted financial squeeze. They've consciously chosen to accept a big short-term accounting loss, made worse by inflation accounting rules and heavy interest payments, as the price for achieving something bigger.
Which is that deep vertical integration, the regulatory alignment, building that moat.
Exactly. Building the moat to secure their position as a high-margin, strategically important player in a market that's set for massive growth both in Turkey and potentially in Europe. They're playing the long game.
And the evidence for the underlying health is there.
It is. That surging EBITDA margin, the positive and growing operating cash flow, that huge jump in deferred revenue guaranteeing future sales, These all point to a fundamentally sound business underneath the financing stress. The Ali-Aza integration seems to be working as planned, shielding them from tariffs, aligning with incentives.
So the future really hinges on execution.
Entirely. Can those newly completed, very expensive assets like NIZE, starting up transition quickly from being cost sinks to being strong cash generators? That's the million-dollar, or rather billion-lira question. They need that new revenue to flow fast enough to cover the financing costs associated with building them.
Which brings us to our final thought, the thing for you to really mull over. SMRTG has made this huge strategic bet on domestic wafer and cell production. They have secured big international grants, locked in long-term revenue streams with CFDs. They've positioned themselves as a key player in Turkey's energy strategy and a growing European force.
But the immediate challenge is stark.
Right. How quickly will the actual cash from selling power from NIZE, from fulfilling those $500 million in new contracts, actually hit the bank account and start neutralizing that crushing short-term debt burden that's currently wiping out their reported profits? That speed of conversion from CapEx completion to bottom-line relief is the critical factor to watch. It's the ultimate test of whether this aggressive debt-fueled strategy pays off. If you found this deep dive valuable, if it helped you understand the complex picture at SMRTG, please do show your support. You can like this video, subscribe to our channel for more analyses like this, and maybe share it with others who are trying to figure out these kinds of investment stories.
Your support really helps us keep digging deep into these reports.
We'll be back soon with another detailed analysis. Thanks for joining us on the Deep Dive.